Good morning, everyone. I'm Mike Begg, SVP and Head of BMO's Canadian Commercial Real Estate Finance team. Thank you all for joining us today. Real estate has experienced its ups and downs, especially this year, but through the years, we have continued to bring together leaders in this industry, a testament of our commitment to you and the sector. This morning, it is our pleasure to again host an informative session on the current state of the market and the outlook for what's ahead. BMO Economics' latest monthly Canadian housing market report indicates still higher unemployment levels and lower immigration levels, but these should moderate demand after a robust rebound from April's pause. But the undersupply remains across most city markets with solid demand drivers. Typically, this forum is hosted in person as a morning breakfast session just prior to the Geneva Centre for Autism's annual Golf Classic. Today, we're hosting this the day before and in a virtual setting. So we're joined by some attendees that might not be as familiar with the golf event. I'd nonetheless like to take a moment to thank the Geneva Centre for their partnership and share a bit about the organization we can all admire. For over 20 years, BMO has been partnering with Geneva Centre for Autism to make an impact in the lives of children, youth, and adults with autism spectrum disorder. This year has been particularly challenging for everyone, but even more so for those families for whom we advocate. Like many organizations, Geneva Centre has been forced to close their doors to families for months. All funds raised from this year's tournament will help with their reopening so that their clients and their families can have access to the therapies on which they depend so much. We'd like to give a special mention to the folks at Access Storage and Storage Vault for their generous and increasing leadership in supporting this tournament. And good luck to our golfers tomorrow. We have a lot to cover in 45 minutes, so briefly, I'll recap the agenda and get started. Our first speaker, Sal Guardieri, my close colleague and senior economist at BMO, will kick us off with an economic update for Canada as a whole, and as it relates to the real estate sector specifically. Sal brings 20 years of experience analyzing the US and Canadian economies and financial markets. He is a well-respected commentator on economic and financial trends and is regularly quoted in the press. Following Sal is Raymond Wong, Vice President of Data Operations at Altus Group. Ray oversees researchers across Canada, ensuring timely, accurate data behind his comments today. He regularly presents to our industry on key market trends, and we look forward to his insights as well. We will then have a roundtable covering the key topics and answer questions that were submitted in advance, as well as any questions that may be voiced by text during this presentation. Moderating that discussion at that point will be BMO's Hisham Abarama. As Regional VP heading my Toronto-based Ontario team, he brings over 20 years of experience in the financial sector, including real estate finance, diversified lending, and investing in private equity-backed transactions, and the design and execution of institutional strategic initiatives across BMO. One last thing before we get started. If you are watching the event on a desktop or laptop, you will see a chat box below the video screen. Please feel free to use it at any time during the presentation to submit questions to the panelists. We will address questions at the end of the presentation on or offline afterward if time runs out. With that, I'm going to turn it over to Sal Guardieri. Over to you, Sal.
Thank you, Mike, and good morning, everyone. So is the housing market immune to the pandemic? Well, with national sales at record highs, Toronto sales up 40% in the past year to new highs, and benchmark prices rising at double-digit rates across many regions of Ontario. One would think so. I would say the biggest surprise of this pandemic is just how rapidly housing markets have rebounded after plunging during the shutdowns. It's even more surprising than the recovery in stock markets, which was driven by relatively a small number of big tech companies that are benefiting from the shift of activity online. For housing, it's almost as if the greatest economic shock of our lifetime never happened. A shock that sent two of the biggest drivers of Canada's housing market careening into the ditch, and that was employment and immigration. But the pandemic also generated some good things for housing, like sub 2% mortgage rates, massive income support by governments that more than offset the loss of aggregate earnings, increased household savings, notably among teleworkers, many of whom are opting out of urban rental markets for an affordable detached home in the suburbs or exurbs. So that's why some of the fastest price increases are occurring in some of the small cities, 1 to 2 hours drive from downtown Toronto. So this pandemic also was unique in that most of the job losses were among lower income workers who tend to rent rather than own. As far as where the market is going, well, I guess the humble thing to say is we really don't know. But since you asked, there's likely enough fundamental demand support, including from millennials and earlier international migration, to keep the market pretty healthy. But the market is not entirely immune to the pandemic. We would expect a substantial moderation in the rate of growth in sales and prices over the next year, just given the elevated unemployment rate. Of course, the virus really will have the biggest say in where the economy and housing market are going. Chris, if we could advance to the first slide, please. Though subsiding, the earlier resurgence in US infections, as you can see from the chart, is pretty concerning. And several other countries that had their outbreak under control, such as Spain, France, and Australia, are seeing regional flare-ups as well. Now, Canada has kept its infection rate low at just 0.5% per day while moving through the various stages of reopenings. And most countries have the virus under sufficient control to rule out a return to widespread lockdown. So that's generally good news, and let's hope it stays that way. Chris, the next slide, please. Now, data on work hours, for example, show the US economy has slowed somewhat in response to the new restrictions on bars, restaurants in some states, an increase in consumer anxiety related to this flare-up in cases. You're now hearing more talk of a K-shaped recovery, with the various industries following widely different directions. We know some industries remain deeply challenged, not just restaurants and bars. Personal care, for example, as you can see from the chart, still operating 40% below pre-virus levels. And for Canada, the virus is still hammering about 5% of the economy. So that involving restaurants, hotels, air travel, personal care, and in-person entertainment. And barring a vaccine, these industries are likely to struggle well after the economy returns to normal. The next slide, please. Still, because most industries are healing quite nicely during the recovery, and the recovery is proceeding about as well as could have been expected. Though, as I said, it will take there's still a long road ahead before we see anything resembling a complete recovery. For Canada, the 2-month lockdown recession is just unparalleled. The 18% decline in GDP in March and April was 4 times larger than in the Great Recession, and it simply erased the entire expansion of the prior decade. Now, thankfully, it ended in May with the reopenings of non-essential businesses, and based on our business activity index, the economy looks to have reversed about 2/3 of that decline, with help from basically a V-shaped rebound in retail sales, for example. Now, that said, I mean, we're still operating about 5% below pre-virus levels. Just for perspective, that's worse than at the low point of the last recession. We still think it could take until well into next year before we fully retrace the lost GDP. Chris, the next slide, please. Another unique aspect of this recession was just the massive fiscal response. The income support measures have more than offset the aggregate income losses for Canadian workers. It's a really strange recession when household disposable income rises 15% in the past year. And the federal government has extended the support programs into next year while lowering restrictions on work hours to collect EI. Income support and loan deferral programs have allowed consumer defaults to stay pretty low. Now of course, the support has come at the cost of a massive hole in the budget deficit to the tune of at least 16% of GDP. And that does risk further credit rating downgrade beyond Fitch's recent ding in the country's AAA rating. So at some point, once we're out of this crisis, the government will need to outline pretty credible plan to return to more sustainable fiscal finances. Chris, if we could turn to the next slide, please. Now, Canadian workers have taken a much larger hit this time than in the last recession. 3 million workers were let go in March and April. Less than 2/3, or about 63%, have returned to work now. Of the 2.3 million unemployed, 2 million are basically permanent layoffs, and that's up from 1 million at the start of the year. And the layoffs are concentrated among lower paid workers in the hospitality, entertainment, personal care sectors. So clearly that will act as somewhat of a drag on the housing market going forward. And besides that, we will need to contend with many fewer international migrants, at least this year. If we can advance to the next slide, please. Net international migration to Canada has fallen about 44% now in the first half of this year. So that's just an unprecedented drop, coming off the record levels we were seeing in recent years. Now, because international migrants tend to rent for a number of years before getting into the housing market, I think the impact here will be more on the rental market than the housing market, though probably in future years we could see some drag on the housing market. But the market, I believe this year will be pretty well supported by the past record levels of international migrants, 341,000 new net permanent residents last year to Canada. And that's right in line with the government's target for this year and the next year. It's going to be tough to hit that target this year. But I think once we start easing the travel bans, as people become more mobile and comfortable with traveling, we could see immigration pick up in Canada, providing support to the market. Can we advance to the next slide, please? The monetary policy response to the pandemic has also been pretty substantial. The Bank of Canada chopped interest rates to near zero now and is buying a wide range of debt securities to keep long-term rates down. We don't expect the bank or the Fed to begin raising interest rates until at least well into 2023, given the enormous slack in the economy and downward pressure on inflation. And the Fed now is following a strategy of allowing inflation to temporarily move above its 2% target to compensate for past undershooting. So again, we're going to be facing low interest rates for a long, long time. Next slide, please. Now, the good thing about the falling interest rates is that they've stabilized affordability across Canada and really provided some offset to CMHC's recent tightening of the mortgage rules for insured mortgages, notably requiring housing costs to consume no more than 35% of annual income instead of the former 39%. But we know housing is still very expensive across the Greater Toronto region, where mortgage payments can gobble up almost half of income on just a typical property. But that's not the case in most other cities where the mortgage service ratio is less than 1/4 or even less than 1/5 of income. So many cities, Ottawa, for example, much of southwestern Ontario as well. Chris, the next slide, please. Along with the record low mortgage rates, we're getting pretty good ongoing support from the echo boomers, the millennials. They're taking full advantage of these low interest rates to get into the housing market, buying their first home, for example, or moving up to a bigger home. So that age group, 25 to 34, your prime first-time buying age group, is still growing at a pretty good rate and will continue to do so for several years. And millennials also taking advantage of the ability, at least those who can telework, to buy cheaper, larger properties outside the Greater Toronto region. So that's helping them deal with the affordability issue in this area. Chris, the next slide, please. So it's it's a return to that buyer's fever where we were seeing across many housing markets in southern Ontario prior to the pandemic. GTA sales, as I mentioned, are up 40% now in the past year to August to new highs. They're rising even faster outside some of the 905 region and 416 region. So, we're seeing some of the fastest sales gains across the Golden Horseshoe and the Niagara region, Kitchener, Waterloo. Again, it's teleworkers taking advantage of that opportunity now to just get more living space and avoid a big commute by buying properties outside the Greater Toronto region. Chris, the next slide, please. And it's back to a seller's market. I mean, basically that, we were headed to a very, probably an overheated housing market in the spring, if not for the pandemic. But essentially what's happened is it's postponed that heating up of the market into the summer. So it's back to a seller's market. Sales to new listings ratio back in seller's territory right now. And as you can see from this chart, it's starting to put upward pressure on prices once again. There's historically a pretty close relation between the two measures. And if you just look at the overall number of active listings on the market, there's about a 1.7 month supply right now at the current sales rate, and that's well below historic norms. So that's why prices are rising once again. Chris, the next slide, please. Conditions are equally tight in the new home market, especially here in the Greater Toronto region, where supply is still below normal levels. And unfortunately, money buyers will have to face higher building costs because lumber prices have doubled in the past year. Now, just a rough back of the envelope calculation suggests that could add well over $10,000 to your average priced new home in the Toronto region. So supply is just another issue, again, for much of southwestern Ontario. It's not insufficient demand, it's lack of supply, and builders not being able to keep up. Chris, the next slide, please. And the consequences, we're seeing housing markets reheating again. Prices up 11% in the Toronto region in the past year to August. And in some other cities, at least to July, up even faster. You can see from Kitchener, Waterloo, up more than 20% in the past year. Same in Brantford. So again, some of that influence of teleworkers buying properties outside the Greater Toronto region is driving up house prices in those parts of the province. The next slide, please. The one area of the market, the housing market that's soft, perhaps no surprise, is the rental market. GTA, Greater Toronto rents are down about 7% now in the past year, and I think a little more even in August, 9% or so. Prices are down, and that's simply reflecting insufficient inventory and some pullback in demand. So the inventory is still inventory is actually ramped up pretty significantly in the past year now in the Toronto region, up 8%. We've gotten a flood of new listings from Airbnb, listings that normally would fill the short-term market for tourists is now coming onto the long-term rental market. Now you couple that with less demand from many of the lower paid workers who've lost their jobs and taken a hit to income, less immigration, students kind of staying with their parents instead of entering the rental market for education. And it all suggests a shift out of the rental market. And again, you could couple that with remote workers looking for detached homes outside the Toronto region instead of renting in downtown. So that's all putting downward pressure on the rental market. The final slide, please, Chris. So just to wrap up, thankfully this 2-month pandemic or lockdown recession is over. Not for everyone, still a lot of workers out of work across Canada, 2 million, more than 2 million. So that's a big issue. But the housing market basically has not just survived the pandemic, in a way it's kind of thrived, benefiting from a lot of those positives that we just talked about. It's also been helped by the fact that distressed home sales have been kept to a minimum because of the deferral programs, for example. Now, we don't expect home sales and prices to continue at this heated pace. We will see a moderation in the rate of growth of sales and prices to more moderate rates of growth because of some of these permanent layoffs, elevated unemployment rates. And we think the unemployment rate could still average about 8% next year across Canada, less immigration and just economic uncertainty. So we'll see some moderation. We're going to continue to see some downward pressure into the rental market. We'll continue to see a shift, I believe, towards properties in the detached properties outside the Greater Toronto region, certainly outside the downtown core because of remote work. There's still some people that will be going into the office and that, but there's going to be a lot fewer workers going in on a permanent basis now. And just to finalize, the risks, I would say, still probably on the downside if we see this second wave of the virus occurring in the winter when we start moving indoors again. But then again, a lot of talk about an early vaccine that could present some upside risk to the economy and the housing market. So I'll leave it at that and turn the floor over or back to Mike to introduce Raymond.
Thank you, Sal, for your macro level insights and update. There's certainly uncertainty when you have upside and downside mentioned in the summary of the risks at the end there. I'd now like to hand it over to Raymond Wong, who will be giving an update on the microeconomic trends happening in the commercial real estate industry. So over to you, Ray.
Great. Thanks, Mike. Good morning, everyone. Today, I'm going to share with you a few insights and trends on the new housing market, firstly across Canada, and then drill down specifically for the GTH. Okay, next slide, Chris. And one more slide, sorry. And I'm just going to skip over this and just go to this one. The residents, okay, so as Sal mentioned, that the housing market in January and February were really picking up, and then we basically had a 3-month delay with the pandemic, delays in projects, construction halts, and causing delays in the actual inventory. One thing about the residential real estate market, what we've seen is a sort of acceleration of changes and evolution of trends that we're already starting to see in the marketplace, and builders sort of trying to compensate for too much demand, lack of demand, adjusting pricing. So we continue to see that today with the current market, and as the consumer factor employment, and for the most part, people paid attention at home to reduce the case. But because of that sort of uncertainty and where the market was heading, it caused a certain amount of sort of concern and delay. So basically, we lost the spring market. And with respect to just adding on to the interest rates decline, but we've also had more scrutinization by some of the lenders with certain approvals based on employment or additional questions that we're also developers are dealing with, is is the fluctuation in some of the costs, and we know that PPE and the certain protocols that put in place have already contributed to about 13% of the cost. In addition to any type of what's happening with the U.S. with the tariffs and impacting sort of the more specifically the aluminum sector and impact on cost of windows. So there's a lot of different things that are happening that are impacting the residential market. Go to the next slide. And if you look at what's happening with again, just reinforcing, people still want to buy. This is from our firm survey, and basically it shows that there is confidence in the market for people planning to buy new homes in the next year. Next slide. And especially the first time buyers are back in the market. And this has also helped with the interest rate. So again, this is what's sort of fueling what we're seeing today with a lot of demand in transactions, both on the resale market and as well as on the next slide. So this is part of the adjustments that that I was talking earlier about, levels. So low inventory levels continue to happen in Eastern Canada, while slower sales are allowed supply to increase in the West. So there's a lot more sort of pent-up demand that we're sort of seeing in the marketplaces right across Canada, but at varying respect to whether or not a certain amount of inventory. And there's no surprise with respect to Edmonton and Calgary. And we are starting to see sort of a pickup in Hamilton and Toronto, but partially that's also based on the inventory that's available in the marketplace. Next slide. So, and this goes just speaks to the single-family new homes demand is resilient in 2020. A pickup over sort of an extension of what was happening last year, and partly is due to some of the adjustments in pricing that allows some of the buyers to get into the marketplace after a bit of a stall and some adjustments in the last little while. Again, there's a little bit of weakness in Edmonton and Calgary and Vancouver, of course. They sort of they're still coming off of reduced sales in the last couple of years, whereas Toronto has been strong, and as well as the pickup and the increase in activity in inventory and the transition from renters to buying apartments in Montreal. Okay, next slide. And this goes into the affordability issue, and again, this just that based on the price with single-family homes and some of the first-time buyers, that there is an increase in demand and affordability for townhomes right across Canada. So the challenge we have is the low inventory, fewer project launches, and the stall in the GTA, and low-rise has been increasing supply, and activity has been increasing a little bit more. Next slide. And of course, the whole condominium sector, and overall, Kitchener had the inventory. But again, when we get back into the inventory and demand aspect of it, Kitchener had the inventory percentage of change in 2020 year to date that goes into July numbers is up. Whereas Hamilton had a very strong January, February, and based on the policy on some of the delays with some of the completions, all sales are down. It's not because of demand, it's just the lack of inventory. And the same thing with respect to the GTA market for condominium apartment sales. It's just the lack of inventory and some of those delays because the pandemic is delaying some of those launches as we're seeing in the marketplace. Okay, next slide. And this is when you get into the whole pricing aspect of it, that it's really starting to converge on the price points with respect to Vancouver and GTA, and with price escalations in the GTA and downward pressure in Vancouver, and largely it's based on the affordability issues that Toronto has made some changes to pricing, allowing for a little bit more demand. And what sells that are definitely seeing the affordability in outlying parts of the GTA, in particular Kitchener-Waterloo and Hamilton. And be interesting to see whether or not this sort of continues with respect to the flexible work environment, allowing people to work more from home, whether or not, again, it moves more into that acceleration of more movement to the suburbs because of some of that flexibility. But part of that was also that sort of started happening about a couple of years ago when the workers, especially in the tech sector, and companies allowed employees to work a little bit more remotely. And this pandemic has just sort of accelerated that, and be interesting to see what becomes permanent and becomes sort of transition based on the pandemic. Okay, next slide. So when you look at overall land sales, and this is a little bit for 2020. Again, we had about 3 months of inactivity from March to May, and overall investment transactions across Canada is actually down by about between 30 to so when you look at what's happening with land sales, partly it's because of limited product, and as well as some developers concerns, especially with what the asking price is and what the investors and developers are willing to spend on the land. That's caused a little bit of that delay. But year over year, when you look at the GTA marketplace, that we're down by 30%. That's actually not bad, based on 3 months of sort of in the marketplace. Again, what we're seeing with respect to Kitchener-Waterloo is the lack of product, and some of that concern with some of the building costs going forward. So I think this is actually going to probably pick up in the second half of this year and into 2021. But it'd be really interesting to see sort of the bid-ask gap between bidders and sellers, how it impacts land prices and movement. Okay, next slide. Okay, so now we're turning into the GTA marketplace. Next slide. And this is when what we talked about the new home inventory still improving, but that stall the last few months. And this is a little bit in the GTA, say Vancouver, where they had a slowdown. But what we're seeing now with the inventory is the impact of the COVID protocols put in place. Construction goes a lot faster digging a hole, but once the especially the high rise starts sort of gaining in height, that's when you have some challenges with the number of people that can allow to following some of the workers up and down, and again a little bit more sort of activity. It's probably going to slow down some of the completions in the marketplace in 2020. Next slide. And this is the GTA new home sales, and it's not a surprised with what we've seen compared to 2019. Again, we didn't have a spring market. There's still a lot of pent-up demand, and as Sal mentioned, with on both the resale side and the new home side, that there's a lot of people that are still looking for homes, and we've seen, especially on the new home side, come up in June, July, and we're also seeing sort of more sort of high-rise openings, but it's again because there's certain restrictions in place. It's by appointment only, or the case of 99 Church with their launch, they rented out a drive-in movie theater, launched their development. So again, we're probably going to see a lot more demand and activity. The concern is sort of going to 2021, and based on some of the comments with uncertainty with what jobs are permanently lost and what jobs are created, and as well as whether or not there's going to be a second wave, whether or not we might see a slowdown in that demand in sort of the second part of 2021. Next slide, please. And when you look at the condominium apartment sales, 905 and 416, and we've seen the evolution of the condo 5, especially in the growth around the bottom metropolitans and downtown Markham, Mississauga City Center. Again, it allows for people to live by having urban amenities. We're close to, in case of the bottom metropolitan center, office, retail, and residential. And again, we started seeing this evolution a number of years ago with because of affordability, and it also helps public transit investment starting to pay off. That it still gives people a lot of access to downtown. So we're seeing increase in that gap between the 416 and the 905 with sort of narrowing that number. And one of the things that we keep being asked is whether or not office is dead, especially in the downtown. And we don't necessarily see it as such. That there was already that push, especially as people had kids and they needed the space to move into single family homes and move into space out of the downtown. But the downtown has a certain number of amenities, and there's a reason why people are moving downtown, not because of jobs, but it's sort of a lifestyle. So we don't see sort of seeing this changing that much, but we do see some of the hybrid work environment where you work 3 days from home, and then 2 days in the office. But there's other concerns, and this is still to be played out based on what's happening with respect to public transit and whether or not people feel safe going on a bus and being in the office. But there are a little bit of concerns on the office side, but we think that the office market will continue to evolve and change as the work environment changes. Next slide. And this is where we're seeing the single family homes by regions. The negative numbers is more of the lack of supply. And again, you've seen that growth with respect to York region and what's happening with the outside of the natural 905 with especially Simcoe County and what we alluded to with Hamilton. So there is that sort of push out for activity and people looking for a little bit more room. Next slide. Condominium apartment prices continue this gap here, and that gap is narrowing, and after that uptick. So again, this is also prices have sort of moved up, but it's also based on the type of new developments that are hitting the market that are pushing that up as well. So we are seeing new home prices but perhaps not to the same degree with that spike up that we're seeing on this chart. The next chart. And this gives you an idea. It's the first time that we've seen this, where apartment condos are actually priced higher than townhomes. And again, that's more reflective of the type of the marketplace. And this is why we're also seeing a stronger demand in semi affordability and for more space. Okay, next. Sorry, next slide. Sorry. No, sorry. Can you go back one? Sorry. So it shows you the way of affordability. That still affordability issue in the GTA, where only 40% of the homes are priced under the $1 million range. But you're starting to see some adjustments there with some pricing, but there are still some issues there with respect to, even though we have lower interest rates, and some of the concerns in the marketplace that are sort of causing a little bit of that push outside the 905s. Okay, next slide. And single family prices more aligned with the marketplace, and we've seen some changes, even though that we are seeing the prices go up a little bit over the past year in 2019. That we did see sort of a price in the GTA and in GTA, and we're probably going into we're going to see a little bit with adjustments. Okay, so sorry, Chris. Can we go to the next slide? Yeah. Okay. Deceleration and prices again in the GGH this year, and again that's basically the with respect to product. Next slide. The new unit releases, and this is the challenge in the GTA and GGH, with the pause in the marketplace, that developers are actually trying to push through certain completions, just in case there's a second wave that hits. So we're going to see a lot more launches going into the end of this year. And, sorry, next slide. So this shows you the shortage of immediate occupancy. Again, there's not a lot of sitting inventory. So basically, what is being marketed is being sold, and that is a reflection of the pent-up demand, especially when activity in both pre-construction, under construction, and very low standing inventory. Okay, going into what's in store for 2021. Next slide. Just so this is not a big surprise based on the data and looking at the demand that Kitchener, Waterloo, Hamilton offer more affordable options in the GTA, especially in the under 770,000 for condos. And this is probably expected to grow as employers become a little bit more flexible with work from home. Final for and this the final slide. So the key. So again, we had 2-3 months of loss based on COVID, where housing preferences would change, but the housing goes will not. So we're still seeing demand. Buyers, and they're coming back with respect to low interest rates and pent-up demands in the GTA to that spring market that we were seeing issues with respect to some of the pricing and affordability with Vancouver. And generally, there are sort of underlying challenges, but and there's a lot more some announcements by builders and the residential side. And what Sal said earlier with respect to the impact with the government funding and whether or not when that sort of burns off, whether or not there's going to be confidence to actually continue to buy or whether or not they're just going to focus on necessities. And there's other global factors such as tariffs and other things that are happening in the marketplace that will impact it. And again, what is immigration or that stall this year and what's happening with international students impacting the rental market and the delay in the immigration impacting the new housing market, probably not this year, but in the next 2 or 3 years as we start to feel some of that delay. Okay, so that issue was a run through and to
Great. Thank you, Sal. And thank you, Ray. Those were great presentations. Lots of information packed in there. And I think, I come away walking from it just indicating that there's lots of positivity really in the real estate market despite the pandemic. And there is obviously upside risk and some more downside risk that we see. But overall, the real estate industry within Canada seems to be chugging right along. And that is good news. So we're going to get into the Q&A. I encourage you to send through some questions. We have some already that I'm going to run through with the guys through a roundtable here. But if anything comes up, please, I encourage you to submit through your questions and we'll go through them. So let's get right to it. Sal, I know that Raymond hit on it a little bit, but just, and you spoke about as we look at some folks leaving the urban centers due to the lack of commute now, people are working from home and really cutting down on their expenses and looking to move out. What's your thought on that? Having been, it's only been a few months now in the pandemic, and I know we might have been trending that way, but does it seem short-sighted for people to maybe do that now? And do you anticipate a return back into these bigger markets?
Well, I think there will be a fundamental shift. We just don't know how large it will be towards the suburban exurb markets, simply because remote working, that genie is out of the bottle right now. I think workers and businesses just realize the benefits, in particular in terms of time and money saved. So I think that will be a long-term shift. There will still be demand for offices, and people will still go into the office, but more on this hybrid basis or temporary basis, flexible basis, maybe 1 or 2 days a week, maybe less. But pretty clearly, most surveys are suggesting people generally like that flexibility offered by the ability to remote work. So we will see definitely less demand for office space and less demand for housing in the urban core of big cities. If someone only has to go into the office 1 or 2 days a week, a 1.5-hour commute doesn't look as onerous as going in, on a permanent 5 days a week basis. So I think we will continue to see a lot of people looking at larger properties, detached homes at least, in the greater Golden Horseshoe region for the next while, even after we get a vaccine for the virus. There'll still be a lot of demand for housing in the 416 region and for condos, but we definitely will see some permanent shift in that demand for affordability reasons alone to the suburbs and the exurbs, well beyond the greater Toronto region and well beyond some of the inner core of big cities.
Sure. No, thanks for that. And we're certainly seeing that. I was with clients in Collingwood last week, and demand has never been stronger. And they have it's not the folks in their 60s that are looking to move out there, but it's really the 30-something and the 40-something that have very strong interest in being in that area. And as you said, mainly for lifestyle, while not sacrificing their work and careers and whatnot. So yeah, thanks for that. I do have a question that just came in from the audience, and it's around inflation. So the question is, with money being printed very, very heavily and the production of goods falling across the world, how can there not be inflation or even hyperinflation like we have in the prices of lumber would be a good example of that?
Yeah, it's a good question. We're definitely seeing inflation, but it's all in assets, stock markets, the housing market, to a lesser extent, the bond market. It's not overall or in general in goods and services, apart from some relative price changes, as you mentioned, lumber prices doubling in the past year. And I mean, going forward, we're not overly worried that inflation will get out of hand. We did not see a spike in inflation after the Great Recession, when central banks undertook large-scale asset purchases and very stimulative policies. They were able to then unwind those policies in enough time before we saw a surge in inflation. So even when unemployment rates were at half-century lows, we were not seeing a spike in inflation. In fact, the Fed was having trouble hitting its 2% target. And the big reason here is automation. The increased use of robots is creating automation anxiety for workers who are just scared to ask for wage increases, for example, because their jobs are threatened. And that automation is allowing companies to generally keep prices of goods and services down. So there may be a risk of inflation sparking at some point if governments don't take back all this stimulus, the central banks don't ease off on the monetary accelerator when the unemployment rate gets much lower. But at least for the next few years, I'm not too worried about runaway inflation.
Okay, that's very, very comforting to know. So appreciate those insights, Sal. Next question we have, and maybe I'll point this one for Mike Begg. And as our clients are typically looking at closing risk and their buyers being able to close on those purchases, we've already seen, and you've noted in your presentation earlier, Ray, about CMHC changes that took over earlier this year. So Mike, curious for the buyers on projects that are going to be closing in 2021, is there any anticipated changes in the banks and regulatory lending requirements or rules that would impact buyers?
Okay, I'm glad to talk to that. And first and foremost, I'll just say that we were expecting a 5 or 10% market value correction at the outset of this back in March. And I think Sal would echo that kind of comment. We thought that there's going to be some softness in market values. And we're not seeing that. It's kind of flat, if not rebounding. And the closing risk profile is also something where we expected to see as much as 5% of pre-sales fall away in an environment like this because of unemployment impacts. But we've seen virtually 100% closing rates across condo projects and low-rise projects as well. So from a regulatory environment point of view, we haven't had any tightening of the mortgage qualification rules, and we've got all-time low interest rates, at least for the near-term foreseeable future. Sal mentioned that they could start going up a couple of years down the road, but certainly not in the immediate future. So I'd say that the answer here on my part is that we've never seen stronger performance. And I'm going to throw something in as an add-on comment just to the portfolio performance of our own debt books at BMO. And I think this is true really across the CED1 banks from me talking to my peers as well. And that's just that we just really have not seen much of a ripple on our construction portfolio. Maybe some delays in some projects, some delayed launches, but it's delays that are manageable for our tier one stronger clients. There has been some noise in the marketplace with a few projects that aren't tier one, but generally the CED1 banks are not dealing with those, and they're not the 80-20 of the marketplace. The place where there's maybe some weakness in the market is more on the non-housing side. If I shift there for a second from your question, I'll just say that Just in terms of retail and office, that's where the impacts have been greatest. But we've seen improving debt service trends. And it's the truth that both on our housing market impacted book of residential construction, as well as income property lending, we haven't sent a single file to the collections group, so to speak, for a default. That doesn't mean that Sal has told me 5% of our economy can't come back without a vaccine. And that 5%, we're going to see small business failures probably mounting in the fall and into next year. But that's 5% of the economy that's at that higher risk, and 95% seems to be carrying that. So I'll stop it there. Hopefully that's a bit more than you asked for, but that's how we're seeing it.
Yeah, no, I appreciate that insight, Mike. And it is very consistent with what we have been seeing in terms of that closing and lack of delinquencies and people actually closing. And it's just kind of interesting to hear what the future is bringing along there, and that really we're talking low risk in terms of that and people being unable to close. 10:58. So I'll just ask a quick one here that just came in. So it talks about demand for housing has become staggered by municipal governments, in particular municipalities not having staff back at City Hall, and it's hurting the industry. The thought is it time that provinces step in and demand that City Halls get back to normality to work with developers and builders? So just curious what you guys are hearing just in terms of that. And just as we talk about lack of supply, I think having folks in City Hall being more staffed up and working as if normal. So just curious, any thoughts at all on that piece of it?
Well, just in a very general sense, I mean, we've had problems for years in Ontario with construction getting undertaken in time. I mean, condo buildings are taking 3 or 4 years to complete instead of a couple of years, and it takes years just to get a permit. So, yeah, any help the provincial government can give municipalities to speed up the permit process for builders can only help the housing market and bring that supply that we need that will limit the heat we're seeing on prices.
Yeah, no, it makes sense. I think it's a little bit of frustration in terms of our clients and our developers looking to speed and getting their projects through the development process and the approval process and getting it online, which will be helpful for the overall market, really. So we're right on time. So I just want to take a moment to thank our speakers, Sal Guibier, Raymond Wong, and Mike Begg as well, for your great insights and a great job there. I want to thank the audience, so our clients. Really appreciate you joining us on this morning. Hopefully you found the session very insightful. We can all agree that these are times like we haven't seen before. But I think just based on everything that we're hearing and the resiliency there is just that we're confident that we will get through this in time. And so, on behalf of BMO, we want to let you know that we're thinking of you, we're thinking of your families, we're thinking of your organizations, and that we are here to help. And so thanks for joining our session. We have a link sent to you by tomorrow at the latest, as this session was recorded. And so you could pass that on to others who have a chance to attend today. And that will be all. So we will conclude our session this morning. So take care, be safe, stay healthy, and talk to you soon. Thank you very much.